Hello, everyone. Welcome to today's session. One more day closer to the weekend. Happy Thursday. Let's jump right in here and talk market conditions. We're still in our overall bull market and bullish conditions in that bull market. I'm going to come back to this chart as well in a little bit, because one of the issues that we're going to start running into now, and we really have been talking about this for several months, is just this location of this trend, where we still topped out on this trend and we're retracing, and then we're starting to curl back up again. And one of the things we want to watch for is some divergence. Divergence on an indicator is when you have one thing doing one thing and then the other doing something different that doesn't confirm that. So, and oftentimes on indicators, when you have a price high and then you have a retracement and then you have a higher high. So let's say this is the S&P 500 right here, and we get this high that looked like this, but then we get a new high on price, but the indicator doesn't match it. That's called divergence. So you get a higher high on the price, but you get a lower high on an indicator or an oscillator or whatever additional, whatever you're using. Typically it's an oscillator because it's slower moving. And it takes some time for it to catch up to price. So price is still our most important variable in anything we're doing, but pardon me, when we add into additional averages or indicators to help us with context, that's all these do, and that's typically all any other oscillator can do, is help you with context. Where are you at in the trend? Are you early in the trend? Are you late in the trend? Or are you somewhere in the middle? They're typically not very good on signals, although it just depends. It really depends. I think anything can work consistently as long as you just use the same thing consistently. But in this case, we want to keep an eye on this because this is just ridiculously oversold still. Okay, this is just all the way up at these levels. We're just lofty across the board. Now we've got two things working for us, and that is a trending move and a breakout on S&P 500. I'm going to come back to this because momentum has had a pretty nice spike on this breakout. We've also seen breadth improving, but not extreme. And sentiment also is performing pretty nicely right here as well. Let's jump over to buy-sell ratio. Buy-sell ratio is expanding. We're seeing it right at 2.66. So a nice rally so far. We're right in these ranges here. When we get some of these shallow ranges, sometimes we'll pause right around this area. So we'll see if that ends up being the case right here. We're also getting pretty extreme on sentiment. Not extreme, but we're approaching that level. We're at 81. Anytime we get up into this upper range, 80, this line is right at 85, then we know we're at an area that it's just not super sustainable for more upside without some kind of a retracement. So when we're talking about that, we'd be looking at, well, that's a heavy line. Let's go back here. And we're above that 50% line. So now we can play like this. Okay, so we may have a retracement, buying the dips still, buying more upside anytime we're in this upper range and it retraces. As long as it's holding it, and then we're adding in, it's just an additional confirmation that we can watch for if we're looking for help with the overall bias as far as the trend goes. And that's what's happening right here. So let's talk about S&P 500. It's really across the board. Let's go with the Qs right here, because I'm going to come back to this 6-month time frame. On really across the board, we've got a breakout. And now what we want to see on all of these breakouts, a breakout is essentially a close above a certain area of price that price has been at before. So when we're running up to an area and it was a resistance area, that's that ceiling. We're just smashing up against that ceiling. But when we break through that, that's referred to as a breakout, and it closed above this price. So that's significant. So now what we'll be watching for is a retest of that. Retest is basically, it's going to come back and we're going to see how significant this support area is. We're testing it. We're retesting it because it's been here before. It's coming back down, and we want to see if there's demand coming back in. If we slide right back through this, then it was a pretty weak breakout. So we're going to keep an eye on that level. That's the area for the triple Qs. Let's look at S&P 500 here as well. 525 is that number on SPY, and Dow, which is DIA, is right around that 396. So interesting that all of these are very similar looking patterns. That doesn't always happen. And we saw the Dow doing some funky stuff early in this trend. It was way back here. The Dow really led us out of the bottom here, and then this early entry here. So it really is a nice pattern. There's a very, very bullish scenario. And if you've ever heard of the term melt up, you hear that a lot in a lot of marketing terms that are out there. But basically a market melt up is an exuberance phase where everyone feels like they're missing out and they just pile into the market. That creates a blow off top because everybody's piling in. You may get some people that are like, I don't know, the market's pretty high right here, I don't think I'm going to buy in. Oh, market's pretty high, I don't think I'm going to buy in. Oh, retracement. Oh, great, we're finally going to roll over, we're going to get a bear market, or we're going to get a deeper retracement that comes all the way back, and then I can buy. And then it takes off. And so now you get these people that are like, man, I should have bought here, I should have bought here, I should have bought here. And they're finally like, okay, let's just buy and let's get in. And as it continues higher, you get more of that, more of fear of missing out. And eventually you can get everybody piling in, and that just melts up. It just is a natural flow higher. Well, that typically is at this point in the trend, that's going to be a negative thing. It's going to be a significant top when we do start to get into this area. So that in mind, just now, let me go back to provide the context, because we talked about that already. We talked about the context, which is this chart right here in relation to where we've been. That's all we can really do when we're using, in terms of price activity and oscillators, we're looking at where have we been in the past, okay? And is that normal? And when we get up into these ranges, this line right here is basically, this center line is that trending zone. Are we in that bullish uptrend? Yes, we certainly are. We know that this price activity is here. Well, are we at the top end of that range, or are we early in that range? Are we early in the uptrend, or are we late in the uptrend? That's a third grade answer, second grade answer, first grade answer, maybe. If you just look at the line and say, yeah, we are at the top end of the trend. Now we're dealing with probabilities. What is the probability that a top end of a trend market goes even to the higher end, to astronomical places it's never been before? What are the probabilities of that happening? It's possible, okay, but the probabilities are starting to decline towards the bottom end of this range. That being said, what this price pattern potentially could do is this retracement. Elliott wave patterns, typically, if you've heard of Elliott wave analysis says that trends act in 5 waves, and they counter trend in 3 waves. So it looks something like this. You get 1, 2, 3, 4, 5 waves of an uptrend, and then these counter trend waves are called, they're labeled as ABC. So you get uptrend 1, 2, 3, 4, 5, retracement. Typically that retracement will pull back to that prior trend. Well, the S&P 500 right here has got 1, 2, and this 3, and it could be working on or just completing a wave 4. Wave 4s can oftentimes be a flat pattern. Flat pattern would look like this. Instead of this counter trend looking like this, you go 1, 2, 3, 4, 5, and you go A, B, C. You get this large flat pattern, and then it moves higher. So potentially we're right around this area on the market. We've had the breakout. The issue is going to be, do we retrace back down and find some support to go higher, or was this the entire counter trend? There's a whole lot of conjecture in what I just said right there, because could it do this? It might do that. It will, that's where Elliott wave analysis is helpful for context. Where are we at in the trend as well? And that's the most bullish scenario. The most bullish scenario is, let's go to the S&P 500, this 2-year time frame. So what I was basically drawing out was this trend, this as a counter trend, okay, here, and then this being the new uptrend. And if this is the entire retracement, which it certainly could be, then this is 3, 4, 5. Or there's even more bullish scenario, and this was a wave 1, this was a wave 2, This is a wave 1 of 3. Okay, sometimes they'll put them in Roman numerals of 3. So this is 2. This is 2 like this. Okay, and then you get 3, 4, 5 of 3. That is the most bullish scenario, and that is a possibility, especially if we see interest rates coming back down. Let's see, where was I headed? I was headed right over here to interest rates. Okay, we saw that interest rates are now starting to move back. This is bonds. So bonds are moving higher right here. We finally cracked that back up into that uptrend. That means interest rates are starting to come down. Markets are reacting to that as well. So you're getting bonds moving higher, which means in the stock market's mind, they're saying, oh, okay, interest rates are starting to drop. That means that the Fed may continue to act. They may start to act on what they said they were going to do in terms of pausing or lowering interest rates. And that's going to create some weird exuberance, I think, in the markets right here. We're just in an interesting phase. If we could really see bonds rally and rates fall, then the market really could have a significant blow off top. Or, I don't even want to call it a blow off top, just a continuation of this uptrend with a significant move. So we want to continue to trust that direction as far as our trades, but we also want to remember the context. The context is we're at the upper end of a very long trend. We're almost, approaching 2 years well, it will be this fall, I guess, from October. We go from October to out to October. Okay, so from here, so we're in this 18 months as of now, this overall new bull market or uptrend that we've been having really for this last length of time. Let's jump. So market conditions, again, providing context. Where are we at in the trend? Are we at the upper end of the range? Yes, we absolutely are. What does that mean in terms of allocation? That's the biggest question is, okay, that's great. Well, now what do we do? Well, what you have to be able to decide then is you go back into the trading plan and you say, what are my goals for this trading money? If I'm trading this money in a certain way, then I'm allocating slightly, and we talk about this every week, and I want to continue to talk about it because it's important, and that is your allocation here. Right now, things have started to move back up again as far as bullishness. When that happens, we don't get stopped out we don't get stopped out from as many trades in those uptrends, and so as we're continue to add in, then we end up with more holdings. Now, and that's great. But as that starts to weaken and we run into a downtrend, then we want to just change that allocation. Maybe we're trading a little bit less stocks. Maybe, I've mentioned this before. One of the strategies you can utilize that's going to be effective for you, and that is only buying or adding in new positions when you have a buy-sell ratio that is greater than 1 right here. Okay, you're going to get the best performance and the easiest performance in those market environments as far as an uptrend and breakouts and the stocks that are moving higher. When we start to get into these retracements and downtrends, it's so even the good stocks may not perform quite as well. Although there's always something moving higher, there may be that's just one more additional risk for a parameter that you can add into your trading plan to say, I'm pretty risk averse. I really don't want to, ride out a retracement. And so I'm going to not add into new positions and then maybe, even lighten up on my losers. The best way or a way to lighten up your position size is number 1, get rid of your losers first. So if you have some stocks that are losers and not quite performing for you and you want to raise more cash, start right here. Okay, a lot of people do that opposite. And that's fine. However people do it, there's a million ways to do things. But in this case, if it's already losing for a momentum style and a stock is not doing what we expect, which is going higher for an uptrending stock, then what are we waiting for? Okay, why are we waiting? Yes, we want to believe that we're right. And yes, we want to believe that the trade's going to work. And yes, we want to believe that we never get stopped out. That's not reality. So we've got to be able to just deal with the fact that we have volatility and ups and downs, and we want to be able to control that in the best way that we can by using position sizing and stop losses. Okay, those are the only ways you can control risk when you are in the market, is position size, how much are you buying, and what is your risk if you are wrong. That is your stop loss location. Okay, there's very, very little that we can control outside of that. The only other thing you can do is nothing, and that is sit on the sideline. Okay, sit in cash and don't do anything at all, which is certainly an option. We talked about this where bond yield, the short end of the yield curve, we're going to run into some trouble at some point. This almost always is predicted a recession. We haven't seen or even had any hints of recession. It's coming. It will come. It's just, the markets just work this way. We're at this area where we don't feel it or don't want to feel it. It's just a matter of time before that catches up. So this is what we want to see now, right? What we want to see is this short. My point was short-term money is paying a lot right now, 5.5% for cash, okay, and not having stock volatility. If that the parameter is risk, the parameter is how much time do you need before you're actually needing to spend that money or that capital or that core amount of that portfolio, and the amount of risk that is associated to that. For the most part, I'm teaching you very, very conservative stock trading strategies, which are looking for uptrending stocks, having a really small position size, 2 to 2.5%, so that you can diversify appropriately, so that one bad trade is never, ever going to kill you. Even 10 bad trades would never kill you utilizing this system. It's painful and it's not fun, but it's never going to blow you out of an account as long as you were following that process. Now, where most people start to make mistakes are they take too big of a position because it's like, oh man, finally this stock I've been waiting for is finally setting up. I think I'm going to take it and I'm going to invest a little bit bigger percentage. Well, inevitably that's the one that blows up. So we want to be able to do this in a way that's structured so that we can continue to play, we can continue to participate, and ultimately we want to outperform the market as a whole. Does that always happen? No. Does it happen often? Yes. But in terms of being able to manage risk, that's the biggest factor. Now, as you're learning to do that, I always suggest trade very, very small. If you're brand new to this and you're still trying to get comfortable, there's two things you can do. Number one, you can use one of the TradersPro portfolios. These are just mock portfolios so that you can set it up, you can track it, you can practice, you can buy, you can sell, you can set up a stop loss. These are just for you to learn the process, because there's nothing worse than practicing with real money. Okay, it's just idiotic. And so you should never, ever be trading real money if you don't know what you're doing. Okay, so trade one share or trade a simulator. Okay, almost every brokerage account has a simulator. I'm using Webull right now, and their simulator is amazing. It's awesome. It gives you almost all of the functionality that you can do with anything live. If the downside of simulators is that it's not real. So if you want to, my next step is if you're trading real money but you're still learning, then it's one share. Okay, it's one share. You're not buying 2% allocation. You are buying one share, and that's all you're going to do for the next 30 days is one share of the stock, and then you're going to track it. You're going to set your stop loss. You're going to take your targets. You're going to trail your stop. You're going to adjust that with one share. Why? Because the volatility on one share, if it's a $100 stock and it drops by 10%, that's $10. You're playing with $10 instead of 100 or 1,000. Okay, and that's one of the ways to be able to get through a learning curve as you're implementing a new strategy or learning a new process without real money being on the line. It's very important to be able to follow that process, to be able to practice. Okay, in what world do you ever jump into something and then are just good at it? Okay, it's not possible. You have to. It takes a huge amount of time to understand yourself. Number one, you may be following a system, but you may not understand yourself enough in how you manage risk and how you deal with money and how you deal with fear and how you deal with greed. Okay, those are all factors that are going to come into play. If you've not yet experienced that, you will, and it can be an eye opener, depending on the size of the position that you're dealing with. Okay, so risk in trading is very, very real. You can lose a lot of money very fast for no particular reason. And so making sure that you understand all of the tools available to you to protect yourself against risk, like position size, like stop loss, like your order management inside your brokerage account, just making sure you're comfortable with those processes. That's why why do you think there are shooting ranges? And people, you got to go and practice somewhere. You buy a new gun and you're like, well, how do I learn? How do I practice? I got to go shoot the thing. Okay, so it's the same way on anything. You have to do it. You just absolutely have to do it. But you don't have to do it with real money, at least not to begin with. For 30 days, practice, learn, understand, be like, oh, okay, I got it. I'm more comfortable. I'm going to go in now with a small position, 1 share, 2 shares, 10 shares, $100, whatever that number is, that is zero pain, absolutely zero pain. If you were to lose the entire position, and you wouldn't even think twice about it. You'd say, oh, I spend that each week on Diet Coke or whatever it is that it should not matter in terms of money. Obviously, if it's a simulator or something else like that, that's easy to be able to do as well. Kind of a little side note there when it comes to implementation of a new methodology or idea without getting frustrated early on, because you're going to make a trade and it's going to lose. You're going to make another trade, it's going to lose. You're going to make another trade, it's going to lose. Then you're going to win, then you're going to win, then you're going to win, then you're going to lose, then you're going to lose, then you're going to win, then you're going to lose. It's just how it works. And so getting too worked up and emotional over those, or more importantly, having like this right here, this stinking little thing will not move and it's about to stop us out and it's just retraced. So we bought it right here. Our stop loss was a little bit deeper. We're just hovering right at that stop loss. I wanted a wide enough stop loss to allow it some space. So now it's just sitting right at that stop loss, and it's going to be one of those ones that just doesn't do it. It just doesn't move. Okay, it just doesn't continue for whatever reason. Is that market conditions? Is that the stock? Is that who knows why it doesn't do what it's supposed to do? Okay, but if it doesn't, I've got to pick a line in the sand, and my line in the sand is getting close right here. But am I worried about it? No, not for a second. Why? Because if you're following your trading plan, this is not a loss. Okay, that is not a loss. That is a cost. That is a cost of doing business. That is an expense for learning how to trade. That is an expense for taking a shot. Okay, you've heard the phrase, you will miss 100% of the shots you don't take. But it's the same with trading. You'll never make a dime if you don't make a trade. So you have to realize that inside of your parameter, inside of your risk parameter and your trading plan, this is not a loser. This is just a cost. This is an expense of having a trading plan, or having a trading business, okay, or just trading in general. It is a part of the deal, and you have to get used to that. Okay, if going back to that basketball, maybe a basketball analogy with Michael Jordan, if he was worried about every shot he missed because he was he knows that his system, he knows that his pattern and his training is going to work over time, but he has to keep shooting. He's going to have a slump. He's going to have a drawdown. He's going to have all of these different things, but you got to just keep going and keep going and keep going. But not with stupid money, not throwing good money after bad. You're doing it in a structured approach. And as long as that structured approach, here's when you will start losing money. Okay, our stop loss right here is at 530. Okay, we're sitting right here on the low at 536. So we're hovering. Okay, if I don't stop out at 530 and it drops to 452, this is losing money. If I do not follow my plan, then I'm losing money. If I follow my plan and I get stopped out, it's just a function of trading. If I don't follow my plan and I wait, well, it'll bounce, it'll bounce, it'll bounce, it'll bounce, it'll bounce, it'll bounce, it'll bounce. And then all of a sudden you're like, oh, hell, I'm going to be holding this thing for the next 10 years because it's never going to bounce. Okay. Don't let a bad trade or a trade that is just not working become a horrendous trade, become a horrendous investment, because now you're going to own that thing forever, and it might take years to recover that. Okay, with the position size that we talk about, that kind of doesn't matter. Okay, but at the same time, this is now lost capital. Okay, this is the problem. Okay, this stop out is not the problem. This is the problem for most traders, is I don't want to stop out, because what if it bounces from here? And I guarantee you it will. I guarantee you there will be 1 or 2 or 3 or 10 that you stop out of and they immediately bounce and rally. Well, so what? Guess what happens with this methodology? We're out. It takes some time. Let's go to another example here, because there's actually quite a few. Let's look at CLS. Okay, even right here, once it starts to move back down, you got your bearish trend. Maybe you're stopped out here. Well, where do you come back in again to be interested? Right here. So we can always come back into a trade anytime. Even if we're stopped out, we can come back into it, because what happens is your trend is now broken. The trend is broken, and we need to follow the plan and say, I don't want to test it and see how low it can go, because this is my loss range. This is my acceptable range of volatility. And typically when we're talking about it, what are we talking about? We're talking about this range, this 382 retracement area. You know, most of the time when we're following a stock higher, we're willing to give it this much room all the way back down. And sometimes that hits, and that's frustrating, but what if it does this? Okay, that's what we're protecting ourselves against. And there's going to be some that we even had one yesterday that had bad earnings, gapped lower. They're extremely frustrating. Earnings have been really frustrating so far this year on a lot of these names, because they're gapping all over the place. In some cases down 20, 30%, in some cases up 20, 30, 40%. So just really interesting with the overall earnings. So a little bit of kind of trading plan discussion more today in terms of managing risk and where to re-enter and following the process. And if you're stopped out, then what? Because there's often times where you may have stocks that continuing heading higher. It retraces, it pauses, because look what market conditions we're doing right here. In market conditions, when did the buy sell ratio go back to positive? Let's take a quick look here, and we go buy sell ratio, right? What was that day? We negative still right here, still negative right here, May 3rd. Okay, so May 3rd, we come back here and look for May 3rd here. Okay, so it's right here. So as that buy sell ratio is bottoming out, you're going to see good stocks. This is a high ranking stock. It's rounding the corner. This is going to be in a watch list, either entering, you know, on the new buy right here. It's just a great place to look for that. So as buy sell ratio is improving, if it's already negative, sometimes, you know, even the best stocks are going to retrace. The market, it's also linked together now, that anytime there's downtrends and selling, it's the baby in the bathwater. It all gets thrown out, and that can present some great opportunities as well going forward. Let's see. Let me just, what time we got? 12:28. Let me just reiterate again, market conditions. We want to be aware of the extension of this trend. Okay. It's up in this 20 range. That's really extended visually over this last 20-year chart. We can see that as well. You know, and these are areas. They're not areas to try and pick tops, because these melt ups, if this in fact starts to continue to move higher, we want to participate as much as we can, and just being aware that it's a risky environment right here, especially with the bond yield curve still sitting inverted, and we're finally seeing the last 3 or 4 or 5 days, finally seeing a little bit of a hiccup here in bonds and interest rates, but we haven't really seen that. So that everything feels good. That's sometimes a clue that we just need to be aware that when things move the other direction, they can certainly do so. We just want to manage that risk. We don't want to be fearful or aggressively be bearish. We just want to make sure we're understanding the risk that is in the market at these levels, and we want to continue to trade that trend as long as we possibly can. That'll do it for today's update. Everyone, I sure appreciate all your time and effort, and we'll see you next week. Thanks a lot. Have a great weekend. Bye now.